Hello, and welcome to another episode of Darwin Investors. We did it, folks. We had a good week. I don't think that I've actually made a video on this channel because I've only had it for a couple of months. After a good week, I was starting to take it personally, actually. I don't know, is it me? Am I doing this to the market? So what we're going to do with this video, it's going to be a two-part series. So it's going to be, first we'll look over how to screen for investment grade stocks, and in the next video, how to optimize your portfolio using stock options, and I'll show you how I'm doing it. So let me go ahead and share my screen and we'll get started right away. All right, so growth hedge funds suffer the worst rout in years. So if you think you're doing bad, look and see how these professionals are doing. Growth hedge funds suffer worst rout in years. And so you see, Whale Rock Capital Management hedge fund lost 15.9% in the month of January in the share class that invests in public and private companies, following a 9% loss last year. Now, this is the part I don't understand. A 9% loss last year. I made 90% my first year in the stock market. I made 90% my second year in the stock market. Now, I understand it's harder to make money like the bigger it gets. So it's sort of like when a company's revenue grows. I think it's like it's harder and harder to make more and more. And this is just something I was doing for fun, but I did make 90% the first 2 years. But these guys lost 9%. I understand they may not be able to grow 90%, but maybe they could generate, I don't know, 1%. According to a person familiar with the firm. Tiger Global Management's hedge fund, which also lost money last year. These guys lost money in 2021 also. Tell me how that was possible. They are lost 14.8% for the month. Another person said Melvin Capital Management, Melvin Capital, remember, they were the ones that backed Citadel after the whole GameStop fiasco. You know, they were the ones that went and poured money into Citadel and helped them out. So Melvin Capital Management and Light Street Capital Management both lost 15% in January, following double-digit losses in 2021. Now, I can understand how you're losing money this year. I just don't know how you lost money last year. So, because this year, if you look at the indices here, the S&P year to date is down 6.95%. The NASDAQ is down 12.25%. And the Dow Jones is down 5% year to date. I'll tell you that right now in my portfolio, I'm down 1%. I'm down 1.45% in unrealized losses this year, which is about, what, 5 times better than the S&P at almost 7%. And it's about 3 times better than the Dow Jones. Well, how am I doing it? Well, I'm doing it with realized gains. I'm doing it with portfolio optimization using selling contracts. So if you look this month right here, if you look from, and I'm calling it this month because February 28th kind of started a week. So if you look at this month this year, I'm up $1,155 in realized gains. So I don't really care too much about unrealized losses because I tend to hold investment grade stocks, and I know if I wait enough time, I'll eventually be up on those too. But from the 28th of February through the 18th of March, I'm up $1,155 in realized gains. And most of this is done with selling covered calls on my underlying equities. And the other thing I will do is when companies are coming up on earnings, the volatility goes up. And so you tend to get more premium for selling way out of the money puts on these companies. And we'll get into that in the next video. This is going to be a two-part series. One's going to be how to screen for investment grade stocks. The next video is going to be about how to optimize your portfolio. And I'll go into all this. But just as a quick overview, you can see that, let's see, CrowdStrike reported a couple weeks ago. I sold a put on them, made $157. I lost on DocuSign, $10. Federal Express, FedEx. So I didn't even know I was going to do some of these moves last week when I made the video. FedEx reported, I think last Tuesday or Wednesday, I made 100, or maybe it was Thursday. I made $117 on that. I averaged down my NVIDIA position, selling puts on them. I made another video saying I'd start doing that around $200, and I was able to do that. So I was able to lower my cost basis on NVIDIA, not by buying more stock, Like a lot of people say, oh, dollar cost average, just buy more down. Nah, you could do it actually just by selling puts on them. You don't have to actually buy any more shares if you don't want to. And then Williams-Sonoma reported last week, again, another investment grade stock, and I sold some puts on them and made some money with that. So, and if you look over the course of the year, just this year, you know, we saw those hedge funds were down, but if we look at what I am for realized gains and losses this year, I am up, I don't know the actual number here. I'm up 90, almost 9,300 bucks just this year. So I haven't been losing money. I think we can all agree that this has been a rotten year, but I haven't been losing money. I've been making money. And I'm going to show you all how to do this. Okay, so let's go ahead and go over this little PowerPoint that I have here. Now, one of the things that you don't learn much about yourself when things are good. You only learn about yourself when things are bad. And what I mean by things are bad are just like things in this context, we're going to be talking about just the stock market and just your investments. And when things are going bad, that's when you really learn about yourself. And now there are a lot of things here that I care about, like in life, like I care about geopolitics, but I'm talking about just with respect to investing. I don't care, it doesn't seem, about inflation. I don't care about CPI data. I know that it comes out on the television set and you'll see a lot of videos talking about inflation, recessions, and a lot of fear and all that stuff in the market and all that. I guess I don't care about that stuff, it doesn't seem, because I never once considered selling ever. I just considered just trading options on the stocks that I own, but I never once considered selling them. I don't seem to care about recession. We might be in a recession right now. I don't know. Maybe there's one coming, but I'm not going to sell. On just for stocks, geopolitics, I guess I don't care that much about that with regard to whether or not I'm holding on to Microsoft shares or not. Oil prices could go through the roof. I'm not selling my Lowe's stock. You know, these are things that I don't seem to care about. Interest rate hikes, well, you know, I guess I don't care that much. You know, you'd think I would sell, say, out of my home builder stocks if I had it, but you know, I guess I haven't. So I guess I don't care that much about that either. I don't care to follow trends. Like if everybody says, hey, ditch all your technology and whatever and get into oil because that's the next hot thing, I think that by the time I've decided to go into that stock, it's too late. I've already missed it. So I tend not to follow trends. It's same with these videos for this channel here. I know that I could generate more channel traffic if I wanted to. I know how to do it. I just choose not to do it, I guess. I mean, I could make videos that would get plenty of clicks and likes and that sort of thing and subscribers. Say, hey, the top 5 oil stocks to buy now when a time when energy is on the way up, you know, and I can go over the specifics of Chevron, Exxon, ConocoPhillips, Diamondback, whatever, Devon Energy. Or the solar stocks were up. Hey, top 5 solar stocks to buy now. Again, I guess I just don't do that. Occasionally I'll make stocks videos that will generate some channel traffic, you know, that cover a certain stock in depth. But generally speaking, those are stocks that I actually am interested in. I own them. I'm thinking about buying them, or I own them and I'm thinking about not owning them. And so I'm kind of going into analysis over those sorts of stocks. But I won't just do it for the sake of channel traffic, generally speaking. But what I did find out about myself was the only thing I care about with respect to investing is, does the company make money? What is their net income like? What is their price to earnings ratio? How much money do they make? And do I expect that the amount of money that they make is going to change? And I can do that based on the earnings calls. Like Advanced Auto Parts had a rotten earnings call, one where they boosted their dividend and they announced big stock buybacks and things like that to keep their price from crashing. It seemed like a desperation play to me. And so I sold out of Advanced Auto because I didn't like the way that company was headed. But for me, the stock market it's just very simple. It's if the company makes a lot of money, then I think the stock will eventually go up. It might go up in a year, it might go up in 2 years, whatever. But eventually the stock will go up if the company makes money. I mean, the stock market is really simple. I spoke a little bit earlier about interest rate hikes and how did that affect my portfolio? Well, I own Toll Brothers. Their earnings call was amazing. It seems that, believe it or not, people that buy $1 million homes don't really. That's how much the average cost of a house is built by that company. It's an inexpensive stock. But it turns out that people that buy those homes apparently don't care about the price of gasoline going up a gallon. I mean, it's sad, but they don't seem to care about that. They're buying those homes anyway, and that was an amazing earnings call. And so so if the company makes money and they have a strong future, it seems, ahead of them, I'll just buy the stocks and I'll forget about all of this other white noise here. And it's that simple. Companies that make money, stock goes up. And so probably about a year ago, I learned about the difference between, say, investing versus trading. There's investment grade stocks and there's trading grade stocks. Investment grade stocks are the ones that have the strong valuation. I'm sure we've all heard about it, the price to earnings ratios and all that sort of thing. Strong money earners. These are investment grade stocks. They generate a lot of net income. They generate free cash flow. Now, a lot of them spend the money. Even the biggest ones like Apple don't have a ton of money just laying around to spend on something else. But they do have it if they need it or if they want it. It's there. These are the types of stocks that you can hold through for long periods of time through any market downturn. You don't care about the stock market going down 10% in a month. You're not going to sell your Microsoft. You're like, it's fine, it'll be back. And these are stocks that you can trade these stocks, and I do trade these stocks. I do that to bring down my cost basis. I don't necessarily do that, just the conventional way with dollar cost averaging. I'll sell covered calls and puts to bring down the price of my stock. You don't get a ton of premium on these stocks unless it's right around earnings time because they're not very volatile. But 10, 20 bucks, it adds up. Eventually it does add up. Trading grade stocks, now these are stocks that I will actually get into. I know I seem like the kind of person that I'm just like a value investor, and I am. I'm a value investor. I'm not a value trader. I'll trade anything. Chinese tech stocks, fine, I'm there, whatever. I'll sell a put on Alibaba, but I won't own it for like 3 years. I'll sell puts on CrowdStrike. I'm not sticking that thing in my portfolio. Give me a heart attack. So these are things that I will dabble in. You'll see me do it all the time. I might hold something like a Lucid for like 3 weeks and see if I can't let that sucker run up and then get out of that stock, swing trade that thing. So there are different kinds of stocks. Now, the trading grade stocks generally have a poor valuation. A lot of times these companies have no net income at all. They're purely momentum driven. Think Snowflake. There's not a lot of meat on that burger when it comes to like Snowflake. There's not much there, but I don't mind selling puts on Snowflake around earnings. It's scary. Do it way out of the money, but these are these types of stocks are the types that are momentum driven. These are the types of stocks that you only want to hold for very short periods of time. And they're also the type that when the market is going down, they're the first stocks that are going to go down. But the thing about trading these stocks that makes them so enticing is that they tend to get a very high premium for their options. And so they're very volatile. And because they're volatile, you get a lot more money for the options. And that's the reason why they're trading stocks. And that's the reason why I'll go in there, because I don't mind getting that money. Let's go find it and get it. So like I said, this is going to be a two-part video. This one right here, we're gonna talk about how to screen for investment grade stocks. We're going to use the Finviz stock screener. We're going to look at the fundamental analysis that I care about when looking for something like this. And this is to help people try and find investment grade stocks of their choosing. Remember, when this is just a screener, then you got to go back in and kind of do more research. But go in there, screen for stocks. You know, not everybody's going to go out and buy 100 shares of like Microsoft, but there are a lot cheap. There are a lot of very inexpensive stocks that are very investment grade. And then in the second video that I'm going to release as part of this is going to be just understanding trading, understanding. It's going to be a very high level, just a quick tutorial over how to use the volatility. You know, how do you know, how important is volatility when it comes to options? We're going to do an overview of the Greeks, you know, the delta, beta, or delta, gamma, theta, vega, and all that sort of thing. Talk about what they are and why it's important to your options trading. And then finally, we're going to put it all together in the next video, and we're going to do portfolio optimization using your options. So how, you know, like the way I was able to make over, you know, $9,000 this year, just trading options, how and just trading in general, how you can maybe try to in your own way optimize your own portfolio to make some money. So that's what we're going to do in this video. We're going to go ahead and we're going to look over Finviz. And in the next video, we'll learn about portfolio optimization. So finviz.com is a free stock trainer tool. Let me go ahead. I'll just open up a window here. You can see you just go to it using Finviz stock screener. And there it is. It's free. You click on screener and it takes you to this window. Now, I've already done this, so on this, I have some things that I find to be a little bit more important than others. So I like a price to earnings ratio. We're going to look for stocks that have crashed a bit, but that are really good stocks, but they've come down. You know, like we're going to try and get a bargain. That's what we're going to go bargain hunting right now. So we're going to look for a stock that has a PE under 25, a forward PE under 20. So now we're talking about a stock that has crashed a bit, that is growing, right? So it's actually should be going up, but it's going down instead. We're going to look for earnings per share growth for the next 5 years of over 10%. We're going to look for a sales growth of the past 5 years of over 10%. So it's been doing well. We expect it to continue doing well. I think that's really good. Earnings per share growth this year, we want it to be over 10%. So it's going to do well this year. It's going to do well for the next 5 years. We want it to be profitable. We want it to have an operating margin over 10%. Companies with very thin margins don't go up. Their stocks don't go up. We're talking about your grocery stores and what else has really little operating margin. A lot of these internet retail companies have no operating margins either. So we want it to have an operating margin over 10%. And we want the earnings per share growth next year to be over 10% and over 10% for the past 5 years. It just keeps growing and growing. So after screening for all this, I got this list of companies here, and I organized it by market capitalization. Market cap would be the number of shares they have times their share price. And we want it to be a larger market cap company because those seems to be the ones that have a little bit more stability right now in this market. These small cap companies are trading at a significant discount to the S&P. And we want ones that seem to be holding their weight. At the top of this list, it looks like it's Facebook. Apparently, this is a very good deal according to this stock screener. This stock screener works in fundamentals and technicals. I'm not a huge technical analysis person. I will use support and resistance when I trade my options. I'll get into that at a later time. We'll do that. We'll dive into that a little bit in just a minute. But primarily, I would go into just fundamentals. So right here, we got descriptive, which would just show what the market cap is and what index it's in and that sort of thing. Over here, you've got technicals, would be your moving averages, your RSI index and that sort of thing, and fundamentals. I tend to buy stocks based on their fundamentals. These are the ones that allow me to sleep at night. These are the ones that I consider to be investment grade. The technicals is like a secondary thing. So Meta platforms or Facebook seems to be a really, if you look at them right here, they're way down. That might be a one to consider. Blackstone Financial, they've come way down. That might be one to consider. John Deere is going up in a straight line. Maybe steer away from that one. Applied Materials looks really good. It's going straight down. If all these stocks are too expensive or you're not really interested in something that, maybe Micron here looks looking really good. So these are going to be some of your bigger companies. Let's see what else is in here. First Republic, there's a bank in here. I really like financials right now. Wow. Financials have been taking a beating. We got interest rates on the rise. Come on, banks. So I don't know why they're going down, but I trust them. Their price to earnings ratios are really low. They trade at a significant discount to the S&P. I'm all about banks right now, and they pay awesome dividends. And they have the earnings that start coming out next month. And when earnings happen, they could actually get a rise. They're going to get a pump going into earnings, and hopefully they get a pump coming out of earnings. So banks look really strong to me. Okay, United Rentals, that's a super expensive stock, but it's there if you have that kind of money. Dropbox, not a big fan. Because I don't know, I've used it. It seems very free. It seems like other companies have file sharing type of ways to get things back and forth, whether it be through Salesforce or whether it be through Microsoft or Google, or I don't know. I just feel like there's ways to get files back and forth. I don't like their moat, I guess I'm trying to say. I like companies that have a little bit of a moat with them. Let's see what's on the next page here. We got Pinnacle. We got Scott's Miracle Grow Company. Okay, that's not bad. They've come way down. That's not a bad one. Toll Brothers. That's the one I like. I like Toll Brothers. That's come way down. To me, that's a good deal. They're trading at 53.42. Ooh, I might lose them. Actually, I have a covered call on them for $54 strike that expires next week. I might lose Toll Brothers. I'll buy them back on a dip. That's all right. InMode, not a big fan. Let's see here. And the reason why I don't like stuff like InMode, this is as an aside, InMode is a company that they do like cosmetic surgical device type things. And what they don't have is a subscription. So you buy their product once and then you're done with them forever. It's almost like buying a Roku or something like that. Once you buy it, you're done. Actually, probably even worse than a Roku. I think a Roku, you can at least put money in afterwards, but not in these guys. You can't do that. So I'm a big fan of those kinds of companies. And now the market caps are starting to get smaller and smaller and smaller. We're starting to get really tiny here. So a lot of these small caps, they just get too little, and I don't know what's going to happen to those. But I tend to like the larger cap companies. Toll Brothers looks like it's a pretty small cap company, so that's, I don't know. I like them, but again, they tend not to go up as much as the market in general. And so that's how I use the Finviz stock screener. These are the categories. You can go back and just hit pause or go back. These are the ones I tend to care about. Let's talk about what I'm going to do this week coming up, because I'm like looking at this earnings and I'm sitting there thinking, well, hold on a minute. What do we have on the pipeline? I tend not to talk about this from week to week because one, people don't care, and two, I don't even know I'm going to do it until right before it happens. But I went ahead and I looked ahead in the calendar. You can look ahead in the calendar using earningswhispers.com. I actually have a subscription to this, so I'm able to use their calendar at will, and I'm able to get more data from them than I would be if I didn't have a subscription. So we'll go ahead and we'll take a look at Adobe. They announced earnings on March 22nd. They're expected, their earnings, which is going to be at $3.38 a share. This would be what it looks like if you have an account with these guys. Here we are on Tuesday. We're going to do all earnings. We're going to see Adobe here, and we can scroll down and see if there's anything else that excites me. Really nothing too much. I was going to make a little bit of money with Adobe. So let's go back to Adobe real quick, and then we'll look at their technical chart here, and we can see that they're trading in a pretty down channel right now. When I sell this put, ideally I'm going to do it like under 400 bucks, and I'm going to try and see if I can't weasel $100 out of somebody, and that's going to be what I'm going to do. We talked about technical analysis and things when we talk about something that I don't really care too much about with respect to investing, but it helps you find a good entry price, I suppose, and definitely it's good for trading. They got the simple moving average of 200-day, the 50-day, and the 20-day. Adobe is way below the 200 moving average. As a matter of fact, here goes the 50-day right here. This is the mother of all death crosses here. When the 50-day crosses over the 20 or the 200-day, that's called the death cross. When this thing backs up and goes the other direction, that's called the golden cross. This Adobe is in a wicked death cross. Why is it in a wicked death cross? Well, it's in a wicked death cross because it trades at a very high price to earnings valuation of 45. The market's not keen on those at the moment. It's got a nice forward PE of 27. I think that's a little bit optimistic. The company really doesn't grow that fast. Other technical indicators that people tend to look at in addition to the moving averages would be the RSI. The RSI determines whether it's oversold or overbought. Oversold to me under 30, overbought over 70 really means nothing. A company could sit over 70 and live there forever. Companies can live under 30 forever, but this is something that some people tend to look at. I'm not one of them, but some people do. There's a MACD, which is probably my least favorite of all of the indicators. Why is it my least favorite? Well, the reason why it's my least favorite indicator is because it's a trailing indicator. Like, so when you look at MACD, you would look at something like this and you would say, oh, here's your MACD crossover. You'd say, okay, here's your signal line, here's your MACD line. Okay, now the signal line goes over the MACD line. Okay, sell. And then you say, okay, now we're gonna watch this. Oh, here comes the MACD. Oh, just went over the signal line. Okay, buy. And then when you look over this, it's like, oh, maybe so. Okay, now sell. Well, the problem with this indicator is this. I think you can see what the problem is right now. The time to buy this stock would have been down here. And now this thing's telling you to buy it clear over here, which is fine. This is a good example of the way it works. But it's not anything that it's like by the time it's telling you to buy it, the stock is on the way up. And then it's kind of telling me, wow, you should have bought it back then. And it's a trailing indicator. Like basically as it's happening, you can't tell whether to do it now or later or then. It just tells you when you should have done it before. And anything that just tells me what happened or what should have happened and what I should have done, I'm not interested in. And that's why I can't stand the MACD. So MACD would be another indicator, a technical indicator that people seem to like. The one that I actually will use is going to be support and resistance, because I tend to think that there's a little bit of realism with that, meaning that let's say we've all been there. You know, you buy a stock for $100, it goes down to $80, and you think to yourself, what? If it goes back up to $100 again, I'm going to sell this pig, right? And so you're sticking there looking at a loser. So, but as long as you bought it at 80 and it never goes below 80, you're happy to wait and see if it goes up. And that's why I think support and resistance is actually real. Support and resistance on a whole entire index, I think, is a bunch of garbage. Like you'll see people come out on television and talk about the support and resistance of, say, the S&P 500 is at 4,200 because it's at 42. Well, this is 500 stocks. Don't tell me about the support of 500 stocks all at the same time, the resistance of 500 stocks. But they'll act like that's some real thing to do. But anyway, so let me go ahead. I'll just go ahead and end this part of this video here right now. I'm going to go ahead and trade Adobe this week. I think I've given you all my thoughts on the stock market, on investment grade versus trading grade stocks. I've shown you a stock screener that I like and the indicators that I like, and kind of help you on your way. So if you want to go ahead and look at these kind of stocks, you go ahead and do that. In the next video, I'm going to cover how to optimize your portfolio using options. I'm going to dive in a little bit into volatility, the Greeks, and that sort of thing. If you got anything out of this video, yeah, please like, subscribe, hit that little notification button. And until then, we'll see you next time. Bye.